In 2022, the European Union and its G7 partners froze over $300 billion in Russian central bank assets, aiming to cripple Russia's war machine after its invasion of Ukraine. This was a seismic shift. Sovereign assets, once untouchable, were now a weapon of economic warfare. The majority of these funds, held at Euroclear in Belgium, represented the financial core of the Russian state, not just oligarch wealth. Moscow's response was swift. It seized the assets of major European corporations operating in Russia, using new laws to take control of factories, energy projects, and bank branches. This tit-for-tat escalation turned a geopolitical conflict into a full-blown economic confrontation, with both sides suffering heavy losses. European businesses suddenly found their investments expropriated, while the Kremlin sent a clear message: seize our state assets and we'll seize your private ones. The result? A protracted struggle that shattered trust in the global financial order. The world watched as the rules of international finance were rewritten in real time. The consequences would ripple far beyond Europe and Russia. Freezing Russia's central bank assets was a coordinated, unprecedented move by the EU, US, and G7 allies. Overnight, Russia lost access to nearly half its reserves, digital entries in Western institutions, not physical cash. The West argued this was a proportionate response to a grave breach of international law, using financial power instead of military force. The distinction between immobilizing and confiscating assets allowed Europe to act quickly, sidestepping thorny legal debates. For Russia, the shock was immense. Its fortress economy, built on supposedly untouchable reserves, was suddenly vulnerable. Moscow imposed capital controls and scrambled to reorient its economy, learning the hard way that access to Western finance is a privilege, not a right. The freeze exposed the immense power of those who control the world's reserve currencies. It also set a precedent that would haunt the global financial system. As frozen Russian assets generated billions in profits, Ukraine demanded these windfalls be used for its defense and reconstruction. In 2024, the EU agreed to seize not the assets themselves, but the interest they earned, redirecting most of it to military aid for Ukraine. This compromise stopped short of outright confiscation, but still marked a dramatic escalation. The move sparked fierce debate. Some EU states feared legal blowback and Russian retaliation, while financial leaders worried about the euro's reputation as a safe haven. Ultimately, strategic urgency won out, and a new funding stream for Ukraine was born. By leveraging Russian profits to buy weapons, the EU crossed a new line, turning financial sanctions into direct support for war. Moscow called it theft, Kyiv called it justice. The economic conflict had entered uncharted territory. Russia retaliated by seizing the Russian-based assets of European giants like Uniper, Fortum, Danone, and Carlsberg. New Kremlin-appointed managers took over, locking out European parent companies and wiping out years of investment. The message: for every euro seized from our reserves, we'll take more from your corporations. This asymmetric retaliation inflicted direct pain on Europe's private sector, creating powerful lobbies against further escalation. Companies faced billions in losses, and no way to exit the Russian market on their own terms. The Kremlin's strategy was clear: make Europe's economic pain outweigh its resolve to support Ukraine. The exodus of Western firms from Russia accelerated, but not before Moscow had extracted maximum leverage. The economic war was now personal, targeting boardrooms as much as governments. Europe's own policies had come full circle, hitting home. The Kremlin's asset seizures sent shockwaves through European industry and politics. Billions in losses forced companies to rethink their global strategies, while business leaders quietly lobbied for a softer approach. The economic pain fueled political divisions within the EU eastern states pushed for tougher action, while others, like Germany and Austria, grew wary of further retaliation and reputational damage. The EU's unity began to fray, with decision-making slowed by internal dissent. Moscow exploited these cracks, aiming to make the cost of supporting Ukraine unsustainable for Europe. The cycle of escalation, retaliation, and political backlash became a central front in the economic war. The EU's resolve was tested not just by Russia, but by its own internal pressures. The future of European solidarity hung in the balance. The West's freeze on Russian assets sent shockwaves through the global financial community, especially in the global South. The principle of sovereign immunity was shattered. If it could happen to Russia, it could happen to anyone. Central banks and sovereign wealth funds began quietly diversifying away from dollars and euros, seeking safer havens for their reserves. The risk calculus had changed. Geopolitics now mattered as much as market fundamentals. Countries like China, India, and those in the Middle East started reducing exposure to G7 currencies and exploring alternatives. The era of finance as a neutral, apolitical space was over. The technical plumbing of the global economy had become a battlefield. The precedent set by the EU forced a global reassessment of where and how nations store their wealth. The ripple effects would reshape international finance for years to come. In response to the Russian asset freeze, central banks ramped up gold purchases, seeking safety outside Western control. Gold, immune to digital sanctions, became the ultimate hedge against geopolitical risk. Meanwhile, countries diversified reserves into currencies like the Chinese yuan, Swiss franc, and Singapore dollar, chipping away at dollar and euro dominance. Alternative payment systems, like China's CPS and Russia's SPFS, gained traction, offering ways to bypass Western sanctions. Bilateral trade deals in local currencies, such as India and the UAE settling oil in rupees and dirhams, signaled cracks in the petrodollar system. The dollar's hegemony isn't collapsing, but the global financial system is fragmenting. Parallel systems are emerging, designed to circumvent Western power. The asset seizure, meant to demonstrate strength, became a catalyst for a multipolar financial world. The long-term shift is clear: trust in Western neutrality is fading. The global order is being rewritten, one transaction at a time. The EU's decision to seize Russian assets will cast a long shadow over global finance. Trust, the foundation of the system, has been shaken. As Western financial centers are no longer seen as neutral, the world is moving toward fragmented economic blocks, with cross-border investment and cooperation growing riskier and more complex. Proponents argue the seizure was a moral imperative. Critics warn of lasting blowback, from corporate expropriations to accelerated de-dollarization. This watershed moment marked the end of assumed neutrality in international finance. The future will be shaped by competing currency blocks, parallel payment systems, and constant geopolitical risk. The legacy of this decision will define the next era of global economic power. The meaning of trust in international affairs has changed, perhaps forever,